Hello guys and welcome back to my YouTube channel. Today we're going to be going over why startup valuations are starting to flatten out. We've had some highs, we've had some lows, now things are starting to get back in the middle. If you're curious about why this is happening, stick around and you'll find out. Cue the intro, let's go. Alright guys, so as stated before, right, we're going to explain the monopoly of why startup valuations, right, which can be defined here on the screen. I have tons of videos about it. Why this is occurring, right? We had things going on like the big COVID boom, which led to a lot of overinflated valuations. Then we had those expectations kind of come down. So here are the root causes about why startup valuations are starting to flatten or reach back to more reasonable levels. First one's going to be market saturation, and this one's actually a very easy one to describe, right? So market saturation is when a certain type of sector, let's go with AI because, well, this actually happened, right? As soon as you got your ChatGPT and all the other chatbots and generative AI type of figures that kind of fell in, then you can see after a period of time, the competition became so fierce. Now you only have leaders and trends that were able to actually make it out of this, right? And one of the things that are sticking out from market saturation is no longer generative AI, but other sort of AI type of sectors and integrations. Like, I'll give you one example, like AI in the creative space seems to really be making a killing right now. But that's because things kind of had to iron themselves out due to the competitive nature of emerging technology in the startup ecosystem. So guys, let's go to economic factors, right? And I probably shouldn't beat this one with a dead horse, but what happens on a global and a micro scale does impact certain sectors. For example, during the post-COVID boom, right, investors got really confident into the state of the world, started doing a lot of overvaluations, and that was met with a lot of turmoil. Like when you read things about WeWork and other things, but also investors learned that this was no longer a viable thing to do whenever you get excited. In fact, over 3,000 startups worldwide shut down because of the post-COVID overvaluation boom, because companies were getting overvalued and just did not deliver the results. But now, right, since we're kind of cooling down from what also happened in an economic factor, the global supply chain and global inflation, interest rates, especially in the United States, right, that are going back down, now investors will be looking for safer bets. And going back to the market saturation, we're seeing what type of sectors are kind of evening themselves out. Also, investor caution, right? Now, globally across all types of factors and facets, we are experiencing right now that there's less deals, right? Or as you know, as deal count being dispersed over this time last year. And this not only in venture capital, but in private equity. And if you know the scale, this kind of goes up and back down like that. So with that being said, right, there's been a lot of high profile startups that have crashed in recent memory. And this is causing not only investors to not invest in startups, but limited partners to not invest in venture capital firms, family offices to not invest in startups, and overall startups as a alternative asset class is not being looked at very favorably. Now, that number has slightly increased because the exit value is starting to become higher despite less deals, but we're going to see a lot of things. So the next one I'm kind of going to go over, right? Regulatory changes. Now, this brings a lot of complexity, right? Because you deal with a lot of industries that have to comply with this. Crypto, climate tech, green tech, and all these other things. I'll be going over a few examples, right? So right now, one of the things that's causing things to flatten, especially in the Web3 space, blockchain became a little bit more deregulated, and crypto is still a little less unregulated, but it's just not delivering based on the value add. So that's one example. Another example would be in climate tech. One of the biggest type of pushes to alternative energy would actually be hydrogen and hydrogen cells, and a lot of deregulation, the Inflation Reduction Act, which was one of the biggest US investments in alternative energy, and the fact that there's actually global private equity activity and all these other things going on as well. So regulatory changes do play an impact, and at least in the United States factor, that is a very hot topic when it comes to the presidential election. So with that being said, I do also want to go as well. I think it's worth mentioning too that a lot of other founders are looking to continue bootstrapping instead of raising what's called a down round, which I have here on the screen. So there was a lot of down rounds going on after the 2021 COVID boom when people were raising at less than the valuation, because that was the standard, because money was just in cash was just hard to come by. Limited partners weren't deploying to venture capitalists, and it was just hard to raise money. Now it's a little bit easier to raise money because the due diligence process from the investors is a little bit more, stringent and full of substance, and entrepreneurs, the best and the brightest, are coming out, especially after rough conditions. So guys, this was a little bit of a shorter video, but I hope this helps, and subscribe to my channel.